if you look at stablecoins today, they're a $230 billion market. Those $230 billion rotate on chain to the tune of about $27 trillion last year in 2024, which was greater than Visa's total settlement volume.
Ben, great to see you.
Ted, great to be back on.
So it's been a couple of years. I was looking back 3 years since we did this. I know lots change in the crypto and blockchain world. So would love to get just your sense of the landscape.
Yeah, so we often joke internally that crypto moves in dog years because of the amount of activity that's compressed into short periods of time. And actually, in some ways, it's true because crypto trades 24/7. So you have 168 hours of trading per week versus 32 and a half hours for traditional markets. So you literally have 5 times the amount of trading activity. But on top of that, you have a global market and an open source market. And as a result of that, you just get very fast feedback loops, a lot of trial and error, a lot of creative destruction. And what's happened in the last 3 years? Well, there's been a tremendous amount that's transpired. We had last spoken in Q2 of 2022, and this was really right at the beginning of a distress cycle in crypto. The industry had its Lehman and Enron moment, beginning with Luna, followed by BlockFi, followed by FTX, and then Genesis. And these were, 11-figure bankruptcies, and part of it was a classic deleveraging. But the other part of it was just a material reset for the entire industry. And so that was 2022. But on the back of that, in 2023 and 2024, you really saw builders continue to build and make advancements at the infrastructure layer in the space. So using blockchains has become more scalable, more efficient. The UX has improved. And then at the same time, you've seen this just pretty material kind of what I would describe as a Cambrian explosion of institutional interest in the space. And this is around areas like stablecoins and tokenization. You've seen BlackRock tokenized treasuries. You've seen Fidelity announce that they're going to launch a stablecoin. So you've seen all these different kind of institutions, both on the financial side, but also on the corporate side, really start using blockchains in their day-to-day business functions. And that's been exciting to see. We've always felt that, many people look at the blockchain space as this kind of isolated part of capital markets. Blockchains are a $3 trillion asset class. Total assets globally are 600 trillion. So it's 50 bips of global assets. And some people kind of think about it as largely isolated from everything else going on in the world. But what I think you're starting to see is blockchains are really becoming more of a horizontal slice of what's going on globally. So in the same way that you used to have like an internet sector and you used to have internet funds where all people did was focus on internet companies, but now the internet touches every industry in the world kind of touches the internet. And you're seeing that with the blockchain space. We actually recently went through this exercise at ParaFi of kind of reformulating our thesis and mission as a firm. And as part of that, we looked at the missions of other great companies. And one of them that resonated with me was Stripe. So Stripe's mission was to increase the GDP of the internet. And so in that same lens, at ParaFi, we want to invest into companies and protocols that are increasing the GDP of blockchains. And so a lot's transpired, and we should kind of double click into it. But I do think that this is probably the most exciting time to be an investor in this industry because a lot of the noise and a lot of the hype has dissipated. And now you're seeing like actual substance and real fundamental traction.
As we sort of dive into what's happened, particularly with these use cases, really curious about the talent piece. Because since in the last 3 years, first you had this explosion of interest in the metaverse, and then of course AI. So you said that the infrastructure layer, all these things continue to be developed. What have you seen? A couple of years ago, crypto and blockchain was the thing that every young programmer wanted to do. And you'd hear these stats about people coming out of college and that's what they wanted to do. How has the talent moved around?
Yeah. So I think there are like two ways to like look at talent. One is like quantity of talent and another is quality of talent. So many people often look at number of developers or number of GitHub commits, ways to measure how much new code is being written in the space. And I think if you look at those metrics, there's been some organic growth over the last 3 years in absolute terms, but I think there's been a slowing of growth. So the rate of growth has slowed. That's on the quantity side. But on the quality side, you've seen a pretty material uptick, not only in the quality of developers, but also the quality of non-technical individuals in the space. So be on the BD side, on the product side, on the go-to-market side, at the C-level of these companies. Because I think what you're starting to see is there's a surplus of block space. So there's a surplus of blockchains that you can use that are fast and cheap today. So that's not really the bottleneck. The bottleneck is figuring out user experience, regulatory, understanding of KYC, AML, and making sure these products are actually built and can be used by institutions. And for those types of dimensions, you actually need people that understand finance, that understand how corporates think about using blockchains. And so net, the quality of talent in this space, the human capital, is better than it's ever been. And this was a big I remember when we started in 2018, 2019, the people building in crypto were, with a few exceptions, not necessarily people that you'd really want to allocate meaningful capital to. But today, we're seeing people spin out of the biggest hedge funds in the world, the biggest financial institutions, whether it's Robinhood or Stripe, and also kind of big tech companies to build in this industry. It's very encouraging.
So the tip of the iceberg for institutional interest always seems to be Bitcoin. Had this big surge with the election, and would just love to start there with your sense of what's happening in Bitcoin.
Bitcoin is such a unique snowflake of an asset. It is really aiming to be a non-sovereign store of value, and it's been around now for 16 years since the initial white paper was published and the first block cleared on the Bitcoin network, and it's had this Lindy effect, and it's almost become this institutional macro asset. BlackRock recently came out and recommended a 2% allocation to Bitcoin. You now have 11 spot Bitcoin ETFs that launched about 14 months ago, which by most metrics were the most successful ETF launches in history. So BlackRock's ETF had 37 billion of inflows in 2024. And that was the third most of any ETF in the market, all existing ETFs included, and by far the largest first-year launch in history. But I think more importantly than the numbers, this is a massive credentialization of this asset class. When you have BlackRock, Fidelity, WisdomTree, Invesco, all basically saying this is an asset that's worth owning. So now you have 5% of all Bitcoin that's held by these ETFs. You have MicroStrategy that owns a big chunk too. And 70% of all Bitcoin has not moved on chain in the past year. So it's really kind of acting as this macroeconomic hedge against central bank and fiscal kind of monetary irresponsibility. And what's interesting about Bitcoin is that it's a finished product. There's no real additional tech that needs to get built. There will be improvements to the tech stack of Bitcoin, but that's not necessary for the thesis to play out. This is, in some ways, it's better that it doesn't change. That's more of a feature, not a bug. And today, Bitcoin trades at about 10%-ish of gold's market cap. So, but by most accounts, I think is a more beloved non-sovereign store of value for the millennial and Gen Z cohorts. And as this, the greatest wealth transfer in human history plays out, 30 trillion over 20 years, from boomers to Gen Z and millennial, there's just a natural demographic tailwind for Bitcoin. So I think Bitcoin is very well positioned. There's a lot of interesting things outside of Bitcoin, but I think Bitcoin in particular, it's kind of been destigmatized and institutionalized. And I think it's kind of getting ready for a next phase of growth.
So the extent that Bitcoin is that institutional asset, on the other end of the spectrum, it's sort of baffling to me that we still have these meme coins. There's the Trump meme coin and all this stuff. Why is that still part of the market?
I think there are two different perspectives on meme coins. I'll straw man both sides of the argument. So on one hand, Bitcoin is a meme coin, right? There's nothing intrinsically valuable about Bitcoin. It's underpinned by social consensus and people that have decided that it's valuable to them. But no one knows who created Bitcoin. Bitcoin represents a certain zeitgeist in society around governments and libertarianism. For others, they don't care about that stuff, and it's just an uncorrelated macro asset. If you ask Paul Tudor Jones or others that have made Bitcoin a staple of their portfolio. But at the end of the day, there is a bit of a memification of this thing, Bitcoin. And if you look at other memes, and now there was a point earlier this year where there were 5,000 new meme coins created every minute. And the cost of creating these things is negligible, the barriers to launch are negligible. And 99.99% of these meme coins that were created converged towards zero. And most of them were jokes. But what these meme coins do represent, for some, is a cultural affinity. They represent community. And there is an element of community in investing, even in public markets. If you look at something with what's going on with Tesla right now, or what went on with GameStop in 2021. And I do think there's an element of it that's easy to dismiss, but it's always existed in markets. People want to buy things that they feel emotionally attached to. Investing is an emotional and a social behavior. And so, look, I think meme coins from an institutional standpoint are very difficult to invest behind, right? They're kind of like buying lottery tickets. But I don't think they're going away. So today, meme coins are 5% of total crypto market cap. And I think they'll always be here because investing is inherently about, feeling like you're part of something, part of a community.
So if we turn from that to real use cases, I would say real, my word, but I understand what you're saying. What has been the kind of killer app that's made all the blockchain technology not technology in search of a use case? Is a common critique.
There's one clear answer to this question that transcends above everything else, at least today, and it's stablecoins. And so stablecoins, if you look at stablecoins today, they're a $230 billion market. Those $230 billion rotate on chain to the tune of about $27 trillion last year in 2024, which was greater than Visa's total settlement volume, almost 2x that. And if you kind of think about inherently what a stablecoin is, it's a dollar that's put in the file format of a token. And by putting a dollar in the format of a token, it makes it easier to move. So you can move it 24/7. You can hold it sovereignly. So you don't have to, most dollars are held through bank accounts or held through custodians or brokerages or intermediaries and with a different layer of risk. Here you can hold a stablecoin sovereignly directly it's directly in your custody and you have access to it 24/7, 365, no matter where you are in the world. And you can send it in a way that's disintermediated, so you're not going through traditional payment rails. And so where this has really taken off is in cross-border remittance, B2B payments, trade finance, as well as micropayments. So it's very difficult to send $1 on the internet, but you can do that with digital assets. So, actually, I think it was Mark Andreessen that once said, the cardinal sin of the internet is that it never made it easier to send or receive money. It transformed every industry, but it actually the internet didn't really solve finance and money in the same ways. There still hasn't been as much innovation there. And so stablecoins, are happening today. This isn't like a theoretical thing. Hey, blockchain may solve this in the future. The scale that it's operating at today is very powerful. And you've now seen, Stripe recently acquired Bridge, which is a startup in the stablecoin space that was basically building software that allowed companies like SpaceX to pay employees in 160 countries. And what they made it very easy to do is use stablecoins without knowing you're using stablecoins. Because at the end of the day, no one really cares about using blockchains or stablecoins. They just want to send money and receive money more efficiently, more quickly, with better, with better guarantees, without going through multiple correspondent banks, without paying wire fees. And so Stripe made that acquisition. You've had Fidelity that has now announced that they're going to launch a stablecoin. Visa is doing a lot of work, great work in the stablecoin space. And if you look at 80% of all transactions on blockchains involve a stablecoin in one way, shape, or form. So if anyone asks you, like, how are blockchains being used today, it's mostly to like move dollars around the economy. And so, what's really interesting here to me is, like, if you look back, like post World War II, there was this whole concept of a Eurodollar market, where, like, if you were a multinational in Moscow and you had, you wanted to hold dollars outside of the banking system, you'd put those dollars with the bank in London. So it's dollar deposits held to outside of the US. And part of that is you don't want to be subject to, banking regulation and the US legal and political system. And today, the Eurodollar market exceeds the total quantity of US domestic banking deposits. So it's a huge market. So really at its core, you can think about stablecoins really as Eurodollars. And they're being mostly used in these emerging markets. So this trend of stablecoins is, I think, going to be one of the most defining trends of our lifetime. Like, put aside, blockchains, like the idea of moving dollars globally on the internet 24/7 is very powerful. The number of wallets sending and receiving these and the number of stablecoins outstanding have both been compounding at 40 to 60% per year for the past 5 years. And this is particularly impressive given, we've been in a relatively higher interest rate environment and stablecoins yield zero. So it's grown against that headwind. And this is a market that I think will experience 10 to 100x growth over the next 5 to 10 years. So that's kind of like the most clear answer of what is happening on blockchains.
With all of that transaction volume flowing, where do profit pools occur from the economic activity?
I think there are like three primary areas. So the first are the issuers of these stablecoins. Their business model, so if you look at Tether, which is the largest, they have about 140 billion of stablecoins outstanding. And then Circle is the second largest. They issue USDC. They have about 60 billion of stablecoins outstanding. The core business model here is you have a token that can be redeemed for $1. They take those dollar deposits and invest in short-term treasuries and earn a spread. So they're paying zero to depositors and they're earning, in today's market, 4-ish%. And if you look at Tether, last year they made over $10 billion of profit with a small team. And so, and Circle is been public about this. They're gearing up to explore a public listing. So these businesses can be incredibly, incredibly profitable on the issuer side. We can talk about like market structure and whether it will be winner take most or an oligopoly or winner take all. But today, in this rate environment and with the growth rate, they're extremely profitable. The second area would be the blockchain, layer one's blockchains themselves. So if you send a stable coin on a blockchain, if I send you, Ted, a stable coin, I have to pay fees for that transaction. So if I'm sending that stablecoin transaction on Ethereum, I'm attaching some sort of fee to that transaction denominated in ETH, which is the digital asset of the Ethereum blockchain. That's getting burned. And so more and more people are contextualizing like the valuation framework for Ethereum as a capital asset. And you can think about that burn almost like a company using its free cash flow to buy back stock. So the units of ETH outstanding should decline as more and more stablecoins are sent. I mean, there's a number of other things happening in the Ethereum economy, but that is like the essence of where value could accrue. So these blockchains themselves is the second answer. And then the third place is all the different picks and shovels that are getting built around the stablecoin infrastructure. So things like KYC AML compliance software to know who you're sending your stablecoin to, just general middleware that make it easier for corporations to use stablecoins to send and receive them, smoothing the fiat on-ramp and off-ramp process. There are a number of on-chain applications that allow you to earn yield on stablecoins. So if you think about the entire DeFi ecosystem, that's been a major beneficiary from increased stablecoin supply on chain. So the answer to the question is not buy a stablecoin because stablecoins are pegged at $1. But there's all this infrastructure around the stablecoin complex that is, I think, quite attractive from an investability standpoint.
In that first group of the creators of the stablecoin, they're not paying interest. They're earning a lot. What is the structure that allows that to stay in place?
It's a great question. I mean, if you look at, there's been a bit of path dependency. So back when rates were zero, you saw a lot of growth in the stablecoin economy because people didn't really care about earning yield. And also you could take those stablecoins and deposit them on chain in one of these DeFi lending protocols and earn some sort of rate that roughly matched the real economy. But today you're seeing a whole host of different firms focus on yield-bearing stablecoins or tokenizing treasuries. And actually, BlackRock is a great example of this. They recently launched a product that effectively passes through treasury yields, less a modest amount of fees back to themselves, in exchange for passing that yield back to users. And the number of yield-bearing stablecoins or yield-bearing stablecoins as a percent of the total stablecoin market is growing, as it should. So, but look, if you're in Nigeria using, Tether for B2B payments, you may not really care about the 4% opportunity cost of capital. One, you are likely outperforming your local fiat currency. And two, you're just using this as working capital, and it tends to be a pretty great user experience relative to using their traditional rails or cash.
So starting with that treasury example, where is asset tokenization going from something easy and liquid to treasuries to all other assets?
It's interesting because, this idea of tokenizing a dollar or putting a dollar, in the file format of a token is really just formatting, right? And format of assets matters a lot because it makes it easier to send and easier to, it makes these assets more interoperable. But that same concept is, as you point out, being applied to the broader asset stack. So currencies, commodities, stocks, and bonds. And we're seeing a lot of activity in the private credit world around tokenization, particularly around making the fund administration of private credit, amortization, interest payments, cash flow sweeps more efficient. We're seeing activity in fixed income market and equities as well as commodities. So tokenized gold is now $1.5 billion market. But what's really fascinating is kind of the longer tail of esoteric assets that aren't as supported by banks. And we're seeing a lot of tokenization activity there. So whether it's litigation finance claims, carbon credits, farmland, even tokenized collectibles like whiskey or Pokemon cards. You're not going to believe this, but we were invested in a company called Courtyard, and they've tokenized Pokemon cards and vaulted them in Salt Lake City. And there's a huge market for this. They're doing $500 million of GMV annualized, and they're very profitable. And so, there's so many assets in capital markets that are too small to be supported by banks. And what we're starting to see is critical mass and a very high penetration within these niche markets start to develop in tokenization because it's actually solving a very real problem. So I think that we may see more adoption in the longer tail before some of the kind of more institutional assets. But you heard Larry Fink come out about a year and a half ago and say that tokenization is the biggest leap forward for capital markets. And since we went from paper to electronic stock markets in the 1970s, like it's that meaningful because effectively it's this idea of formatting and every asset has a unique QSIP. And one of the great analogies that really resonates with me is if you think about the shipping space. So if you think about like the way goods used to move around globally, there was break bulk shipping, which was, you would have clothes and electronics in cartons and barrels and, loose goods on these boats. And it was very inefficient. And then you moved to these 20-foot containers. And that made utilization higher. It reduced theft. The actual loading and unloading process for those containers on and off boats onto chassis was more efficient. It cut down on time. It increased global GDP in a meaningful way because it increased the modality of goods globally. And that's kind of what tokenization does, is it makes it easier for goods to move. There's not T+10 settlement, and there's just a much greater degree of efficiency.
How far along are we in that adoption?
To me, this is a gradually then suddenly phenomenon because tokenization is like a network effect technology. It's similar to the telephone. If you're the only one that owns, uses a telephone, like it's not that useful. If there's like one other person, it's still not that useful. But the utility of a telephone scales exponentially with the number of participants on the network, right? It's Metcalfe's law. And similar with tokenization, if you're the only one that holds a tokenized treasury, it's not that useful. But as more and more people do hold it, and you benefit from all these features of tokenized assets, it becomes increasingly useful. And that's why when we start to see these long tail assets reach meaningful penetration rates, that's a meaningful catalyst, because if you're an institution participating in one of these markets, you're kind of pulled on chain because it's more useful, because it's the place where price discovery and liquidity takes place.
What are some of the other financial market related real world applications we've seen over the last couple of years take some hold in the space?
So one of the big ones has been prediction markets, and particularly polymarket. So polymarket is really like, they call it a prediction market, which means that you can have a market on whether an event will occur. That event can be in politics, it can be in sports, it can be in science, it can be in culture, and it will resolve at 0 or 1, depending on whether the event occurs or not. And the idea behind these prediction markets are, you can get a real-time assessment probabilistically of what the world's view is, or what the expected value of an event occurring is. So a great example of this was in the presidential election market. So polymarket, which is built on a blockchain, facilitated, I think close to $3 billion on the US presidential election. And kind of the beauty of markets is there's an objective wisdom in them that you don't see in traditional media. Right, so you can, anyone can say anything on X or on LinkedIn or, on CNN or Fox. But if you look at markets, they are a more unbiased source of truth. People have actual skin in the game. What was really interesting there is you could actually see in real time what the market's view on was of what would happen in the election. And there were kind of like two aha moments for me with these prediction markets. One was in the initial presidential debate between Trump and Biden. So as Biden kind of started to falter, you could see in real time the odds adjusting. And then he kind of made a bit of a comeback midway through the debate, and he started trading up again. So rather than listening to the pundits talk about who won or lost the debate, you could just look at the odds in real time. And if you disagreed with them, by the way, you could express that view. And then the other aha moment was the night of the election. After the polls started coming in, the results started coming in from the 7 swing states, Polymarket reached 95% probability on each of those 7 states, in some cases, many, many hours or a day or two ahead of when the Associated Press called the race. So these prediction markets are an incredibly exciting tool for humanity to basically understand what the worldview is on something. And it expands well beyond politics to areas like science, sports, culture. So, you've actually seen Polymarket's volume, stay very strong post-election. And I think that if you think about what this is at its core is, some people may look at Polymarket as like a gambling app, but it's actually a new market infrastructure. It allows people to create a market on anything. How many inches of rainfall will there be, in the breadbasket this harvest season? And that's a form of insurance. You can bet on that or you can underwrite that risk. And it has real business utility. So I think this is an area that will continue to grow.
In the sports betting world has become very big and regulated. How do you think about Polymarket and the prediction markets relative to, let's say, betting and the regulatory regime around it?
I think regulation is coming very, very fast and furious to prediction markets in the US. There's been a couple pretty important landmark cases of Web 2 prediction market companies like Kalshi. But I think that it's going to be very difficult for traditional sports betting platforms to compete with prediction markets at scale. Sportsbooks generally set the odds internally. They'll have an internal bookkeeper, and then they'll do their own risk management. And if they get too much action on, Duke, they'll adjust the odds in favor, to be more favorable for UNC and vice versa, right? To recalibrate. The beauty of these prediction markets is they're just software, and there's no actual kind of market risk that's being taken. There's no balance sheet at risk, and you're just putting these odds out there into the world, and there's a central limit order book with bids and asks, and people are trading these things in real time. And so there's the interesting thing about Polymarket and prediction markets on blockchains is that they're global. So they benefit from global liquidity pools 24/7, 365, versus these centralized platforms where, you have to wire in money, wait for your money to clear, and you're typically only servicing users within a specific geography with artificially set odds. It's a more free, open capital market, which I think produces better insights and more liquidity.
To get a sense of scale, how big or what's the volume that Polymarket's generated kind of through the election you mentioned and then post?
There are kind of 2 ways to think about this. So one is Polymarket is doing about, call it $500 million to $1 billion a month of volume across its markets. And this is across roughly 50 to 75,000 active wallets. That's one way to look at it as a trading platform. But I think the more interesting way to look at this is as a news platform. So Polymarket.com in November was one of the 100 most popular websites in the world and had about 2x the website traffic as Coinbase.com. Most people referencing Polymarket actually had no idea it was a crypto application. So they're consuming the data from these markets rather than trading the markets. The actual odds are set by on a relative terms, not that many people. And so by that measure, and this data is now being piped into Bloomberg terminals and other key data sources because it's actually it produces very, very valuable insights. Post-election, you've seen some drop off in volume, but even the election in Romania, for example, a couple months ago, I think that market had 50 million of open interest. So, 195 countries globally. So there are always elections going on globally. There are at the presidential level and then at other parts of government, in the US, like the House, Congress, you have state races, you have different legislation. So there's always interesting markets to bet on.
What are some of the other financial market related applications?
So DeFi kind of encompasses everything from, lending and borrowing to trading to insurance. So there are two more financialized products. So there's a whole range of different things you can do with stablecoins on chain. And these really started in earnest in like 2020, in the early days of Ethereum, where we realized with these smart contracts, you could basically embed if-then statements, if-then logic to these assets. And most legal agreements or insurance contracts are really just like an if-then statement. Like when you really boil it down, if you buy insurance, it's if this event happens, you get paid Y dollars, right? This market for DeFi has continued to grow. I would say at our core, we kind of call them the ING verbs of crypto. So it's lending, it's borrowing, it's hedging, it's swapping. So if you're earning a staking yield on Ethereum that's floating, you can swap that for fixed. You can securitize different yield products on chain. You can buy insurance on chain on different events occurring. So there's really this full gamut of financial services, this almost supermarket of different financial products that's emerged. And a lot of them are really just experiments and are risky. But a few of them have really established themselves as having credible moats and strong products that are continuing to compound and grow earnings on chain.
What are some of those?
So a great example is Aave. So Aave is a very simple product where you can deposit capital. You can deposit either a stablecoin or a digital asset and earn yield on it. This yield is generated from people borrowing the asset. How do people borrow the asset? Well, they post a digital asset or a stablecoin as collateral and borrow against it up to a certain loan to value ratio. And prices are pulled in real time. So they're effectively incurrence covenants built in programmatically to these loans. So they have, while there are defaults, as you would expect, there's been almost negligible loss given default because of the way the collateral is then liquidated in those scenarios. So Aave, as an example, now has close to $30 billion of capital deposited in its platform, and single-digit billions, maybe perhaps over 10 billion today now borrowed. And it's taking the business model of Aave is it effectively takes a cut of the interest paid by borrowers to lenders. So it takes a slice of the pie. And in a market like that, liquidity begets liquidity and users beget users because people want to borrow and lend from the most liquid, largest market with the most asset support. And so now Aave has now been around. We initially invested in 2019. And so now here we are 6 years later, and it's continued to compound and grow users and earnings.
When we've had this explosion of private credit assets, as an institution's looking at these sort of the blockchain assets as a way to get sort of lending exposure and yield, how do the economics work so that if there's real or perceived risk in doing it, you're getting a premium return relative to where all the dollars seem to be flowing in the credit world?
So yeah, I think that question, the heart of that question is really what's the risk premium for on-chain lending? If I can get, 10% in a private credit vehicle off-chain, what do I need to earn on-chain to make that worth the incremental risk? Yeah. Let me answer that question, kind of taking a step back. So there are there's the risk-free rate on-chain, right? And then there's the risk-free rate in the traditional economy off-chain. And in the early days of DeFi, the interest rate on-chain was much, much higher than the interest rate off-chain because doing anything on-chain was perceived as being more risky. So there was a point in time when, during COVID, when interest rates in the real economy were zero, but you could earn, 15 to 20% unlevered lending on-chain. And over time, that kind of risk premium or perceived risk premium has compressed pretty materially. And we even reached an environment where rates in the traditional economy were in excess. The risk-free rate was in excess of rates on chain. And you could say, well, why would anyone leave stablecoins on chain earning, 2% when they could earn 4% in the real economy? And the short answer was people didn't want to leave the on-chain economy. They didn't want to have to on-ramp into the traditional capital markets for a variety of different reasons. But more and more today, you're seeing kind of those two interest rates kind of reach a more steady state equilibrium. And so for private credit, the incremental yield ultimately is roughly similar between a private credit product off-chain and on-chain. And there's no real discernible difference between the two today because that perceived risk has kind of migrated towards zero. Ultimately, it's a function of who the borrowers are and their probability of default and their risk profile.
What have been some of the most developed applications outside of the financial world?
I would say one of the really interesting areas in the space has been called DePIN. So it's decentralized physical infrastructure networks. And the idea behind this is, can you pay people, if you're a telecom company, you normally would have a lot of CapEx, but can you get people to set up hotspots on a network, to form a network, and give them tokens so you don't have to spend that CapEx, but they do? And so this idea of externalizing CapEx has been what's underpinned the growth of networks like Helium or other of these DePIN networks. DePIN is decentralized physical infrastructure. And so you've seen a lot of experiments here in a company that is basically paying people to attach a dash cam onto their automobile and drive around and basically collect data in real time, similar to what Google Maps would create on what's happening on roads. It's a company called HiveMapper. And they've now mapped roughly, 10% of the world's roads in just a couple years without spending a single dollar of CapEx. They're basically using their native token to incentivize this activity. And they're doing it in a manner that's much more efficient and quick than Google Maps historically was able to do it. So it's this idea of, can you use a token to incentivize people to perform some action in the physical world? And this concept, I think, will eventually extend to other types of networks. Like if you think about something like an Uber, where the drivers, get paid in part with, it'd be almost like if Uber paid drivers in the early days with shares of Uber, as opposed to just actually giving them cash. And then they feel more ownership in the network, and they're participating in the network makes the network more valuable. And you get onto this flywheel. So we're seeing a lot in the DePIN category that is very promising, but we're still early there.
How does the big movement in AI intersecting with blockchain?
So there are a few different areas of overlap. So one of the big areas that we're seeing is this idea of AI agents. So the end state of AI is not an LLM that you put data into and it kind of in a call and response format, but it's really this idea of an agent that can take actions on your behalf. And blockchains were almost purpose built for agents. And we often kind of talk internally that people have asked when are the users going to come to blockchains? When are the users going to come? Well, we think the major users of blockchains just may be AI agents themselves. The reason why blockchains are really useful for AI agents is because they are 24/7, they're programmable rails, and AI agents cannot open a bank account, right? You have to be a human or a company to open a bank account. But if you're an AI agent and you want to send micropayments to other AI agents or micropayments to humans, that's really not possible on traditional banking rails and using Swift, or you really have to go on chain. And so if you kind of look at the way this AI agent economy is evolving, you have flows between humans and AI and humans, but the biggest category is AI to AI paying other AI for kind of micro actions. And that type of activity from first principles, I think makes the most sense on blockchains. And so you're starting to see a lot of AI agents use blockchains, use DeFi, send stablecoins to do things. And while blockchains are difficult for humans to use because the UX isn't necessarily intuitive, that's not an issue for an AI agent. They can figure it out.
How do you think about the risk of that activity? Like the whole sci-fi aspect of, okay, you have blockchain and there's agents moving around. Now you're talking about moving around money. Feels a little scary.
I think there are different levels of autonomy that you can give to these agents. Like you can program them to, with an allow list where they can only send or receive from certain other agents or certain other people. And you can, cap how much you deposit in their wallet and give them discretion over. So there are safeguards, but there are also AI agents that are, basically operating autonomously on chain, buying tokens, trading tokens, ingesting data, and drawing judgments and then expressing those judgments in the market in real time. But, a really interesting use case for agents comes back to prediction markets. So imagine like a polymarket market about how much the Earth's temperature will warm in 2025, right? You can have AI agents that are reading every meteorology publication globally that are taking in alternative data on weather patterns from every country in the world, feeding it into their model, and in real time, recalibrating the probability or to what extent temperatures will warm over the coming year. And how can humans compete with that, right? And so then if you have multiple AI agents that are kind of trading against each other in like a weather market, or how many, Model X's will Tesla sell next quarter, taking all the world's information, you start to be able to look at those markets and say, well, like that's actually like fairly valuable data point if I'm thinking about underwriting Tesla, or if I'm, working at an NGO thinking about global warming. Like these types of data points can be really interesting. And so that's really only possible with AI agents and kind of 24/7 internet rails that blockchain provides. And so I think you're just going to start to see AI agents become like bigger consumers of everything in DeFi, stablecoins, tokenized assets, everything in the kind of blockchain application space.
As we look out over the next couple of years, we sit down and do this again. What other things are you most excited about that may come to fruition?
The game theory around nation states adopting Bitcoin is one of the most interesting things I've ever studied or observed. And, we're now discussing a Bitcoin strategic reserve at the federal level in the US and in 31 states. And you're seeing other governments globally look at that very closely and think about front-running that. And you kind of like think 2, 3, 4 steps ahead and where this is going. And it starts to get very, very interesting and reflexive. And so I think witnessing that adoption curve in the coming years, I think will be interesting, fascinating. And I'm just excited for that, to watch that play out.
Any others?
I think that stablecoins have been one of the interesting things with stablecoins, and we have a stablecoin bill that just passed the Senate Banking Committee and may, get formalized into law in the coming months. But I think the politicization, basically stablecoins have become politicized in a sense, where I think we're going to start to see a fight for. Right now, we just basically have dollar-denominated stablecoins, but I think other governments are not going to just lay down and accept that the dollar is going to win, have a monopoly on blockchains. Right now the dollar is used in 70% of all global commerce in kind of Web 2 or traditional finance. And I think in DC, there's been a wake-up call that it's a huge benefit for stablecoins to win Web3 rails, because every time a stablecoin is issued, on the back end, someone's buying a treasury, and that's in turn incrementally lowering our cost of capital. And Tether alone was the 7th largest buyer of treasuries in the past year. And so if stablecoins grow from 200 billion and change to 2 trillion and change and beyond, this is actually like an area of pretty strategic national importance. And so I think that other countries are going to furiously compete in this market, and the US is also going to furiously try to win this market. And I think eventually, my view is the stablecoin market or tokenized fiat currencies will exceed traditional fiat currencies. And so this is going to be like, I think, one of the biggest races and most competitive arenas where governments are basically competing over blockchain currencies. And I think that's going to be very exciting to play out, and there are going to be a lot of investable themes behind that trend.
We've had a series of crypto winters, even just in the years you've been running ParaFi. As you look out, are there pockets where you are concerned about risk?
Always. I mean, look, and I look at the crypto space, I think 99% of things in this industry are not investable, but 1% are. And the amount of dispersion that you see and the amount of kind of creative destruction is massive. And there's nothing systemic that I see right now where I would say this is going to cause an earthquake in crypto markets. There are a couple risks that I think people have been talking about for a while. One of them is Binance, one of them is Tether, the transparency of those organizations. But in today's market, crypto is $2.5 to 3 trillion. We're below where we were in crypto market cap in 2021, almost 4 years ago, despite all the progress in the space. And there's never been more kind of real economic applications of blockchains that are relevant in the world today than there are right now. And there's never been more institutional interest in the space from the investing side than there is right now. And I think the question is flipped from why should I pay attention to today, it's more, why shouldn't I have exposure? Oh, why don't you have exposure to crypto? Because having zero exposure to the space is almost a view in and of itself, right? This has been the best performing asset class of the last 15, 10, and 5-year periods. So not having a view today, despite, or not having a position today, despite the increased regulatory clarity, despite the institutionalization, despite all the use cases, I think is becoming a bit more of a contrarian view than a consensus view. So, I kind of think about this as a kind of a special moment in time in the market. And I have a bit less worry than I usually do. I'm usually a more worried person and cautious person. But right now it feels like, as I look at valuation and fundamentals, the setup is actually pretty attractive.
I'd love to get an update on the various ways you're participating to take advantage of this opportunity you see.
Yeah, so I think just on a high level, if you want exposure to blockchain technology or the digital asset ecosystem, there's not just a point and click one way to do it. You can invest in liquid digital assets. That can mean just investing in Bitcoin, or you can invest in all of the other 22,000 tokens that are listed on exchanges globally. You can invest in companies in the space, software, fintech companies building services for the ecosystem, right? Those can be early or late stage companies. You can invest in non-directional strategies. You can invest in, there are now public companies in the crypto space, like miners or companies like Coinbase that are providing services. So there are all these different parts of the ecosystem. In addition, just in token capital markets alone, there are private token markets where you invest before a team launches a token. There are what we call pipe Ts that are private investment in public tokens, where you're buying liquid tokens at a discount while agreeing to a lockup. So crypto capital markets are broad, they're complex. Each of those areas has a different liquidity profile, risk return profile, captures a different kind of element of the growth of this technology. And I don't think there's a one size fits all approach. So if you're, endowment or foundation, or you're a family office, or you're a pool of capital, and you want exposure to this technology, you really need to think about, in my opinion, blockchain technology as a slice of your portfolio. And then within that slice, there are different subsegments that give you different types of beta and alpha undercurrents to kind of capture the growth and the upside. So our mandate at ParaFi, the way we kind of view our role in the ecosystem is we're not just an early stage venture firm. We're not just a liquid token firm. We're really capturing kind of the full risk return profile across crypto capital markets. And there are a lot of advantages to doing that. I mean, one is just the information. So we have over 100 different portfolio companies, big and small, that are targeting, focused on different areas of this ecosystem and space. And so we can get the data from our private portfolio companies and use that to formulate theses on the public side. And then on the public side, as we're researching public tokens and looking at trading in public token markets, we can use those behaviors and lessons and then impart them on the private side of our portfolio. So there's this kind of virtuous flywheel in terms of kind of working across the broader ecosystem.
What are some of your favorite stories of, I don't know if you'd call it information arbitrage, but something you learned from, say, trading that applied to something else you're doing?
So the best example of this was, so in 2019, the term DeFi didn't exist. We called it crypto finance. And we started using, as part of our diligence process, we forced ourselves to use every application that we invested in because the best way to really understand something is to use it. We were early users of Uniswap, which is the largest decentralized exchange, Compound, which is a large decentralized lending and borrowing market, MakerDAO, kind of just fiddling around and using them. And as we kept on using these products, we realized to ourselves, wow, this is capital markets that moves at the speed of the internet, right? There are no transfer agents or fund admins. There are no credit agreements or bond indentures. Everything kind of just works and you click buttons and it moves. And just through using these products day in and day out, and we actually became power users of many of these early DeFi protocols, it produced a massive, massive flywheel for our business. One, because we understood what products were good and we ended up investing behind those. Two, we worked with teams because we were power users of DeFi. We could help our private teams build towards where the puck was going and build great products because we were using these things day in, day out. We understood all the nuances and edge cases. And it also led us to develop different non-directional strategies in the space using stablecoins because stablecoins are were the main substrate flowing through these DeFi protocols was. We also found that by using these DeFi applications every day, we had a better sense for what picks and shovels were needed for institutions to use them. So that led us to great companies like Fireblocks or other custodians like Anchorage that are building basically front ends for institutions to interact with DeFi. And those became some of our best investments. So it kind of comes back to the best way to really understand something is to use it. Because there's no substitute once you get, into the arena and you're using a product and interacting with it, you understand what works and doesn't work. It's like being, imagine being a gaming venture firm and never playing the games that you're investing in. You want to have that type of mentality.
What are some of the non-directional strategies? Sort of as an ecosystem evolves, you imagine there should be some inefficiencies to take advantage of?
So in the early days, stablecoins were an area ripe with opportunity. And there were kind of two different types of opportunities within stablecoins. So stablecoins theoretically should trade at $1. In practice, they may trade at $1.02 cents or 99.7 cents. And they trade at different prices on different blockchains or different prices on different exchanges. And so there were opportunities to kind of play the pull to par game. You go short above par, long below par. And there weren't that many pools of capital that were really pursuing that. The opportunities were also episodic. They were capacity constrained, but very uncorrelated, and also had a positive correlation with volatility in the market. Stablecoins tended to kind of depeg when markets were experiencing bouts of volatility. In addition to that, there were markets where you could borrow a stablecoin at 5%, take it and relend it out at 8% elsewhere in a way that was very capital efficient and make a spread. And you could identify these opportunities, programmatically and execute on them. And eventually kind of the markets have become more efficient in reaching equilibrium. So stable coins were really the first hunting ground for alpha from a non-directional standpoint, for us at least. And then as the markets evolved, one of the areas that we're finding very interesting is you have public assets, whether it's MicroStrategy, Coinbase, Bitcoin miners, public trusts that are crypto proxies, right? Even like Robinhood now is getting deeper into the crypto space. And then you also have spot crypto assets. And there are different ways to think about the relative implied and realized volatility between those two worlds, where there are very, very interesting, arbitrages between those two spaces. And then lastly, long short is I think borrowing digital assets has historically been very difficult, but recently there have been massive improvements in infrastructure to be able to do that and to be able to actually, execute on kind of a more fundamental or event-driven long short strategy within the space.
So your firm, I think when we sat down 3 years ago, was probably roughly the size it is today, with the typical with the cycle, a big dip and a big recovery. How do you think about continuing to maintain and grow a business over the next couple of years?
Yeah. So for us, at ParaFi, we have a super long range view on building this business. There's a lot of short-termism in crypto, a lot of medium-termism, but there's very little super long-term focus. And so there's a cultural answer to that question, which is like every decision we make, every hire we make, we want to have that very long-term alignment and build towards what we want our business to look like 10 plus years from now. But really the core of it is we, as more and more institutions enter the space and want to generate interesting risk return profiles and also want to understand this ecosystem, we want to be, the institutional partners for them. And then the North Star is crypto is a secular trend, right? It is, people think about crypto as a cyclical macro asset, but we really think about it as a long-term secular trend. And we want to invest in real use cases that are bringing GDP onto blockchains. That has to be the North Star. Like everything really comes back to that. Otherwise, the space can be very circular or self-referential, things like meme coins. It all has to come back to what are financial applications or other corporate applications for this technology that actually make sense and are actually unlock 10x better use cases because they're on chain. And so that has to be kind of like our North Star as a firm. I'm just a believer that in building a business, you have to, to build something extraordinary, you just have to do something consistent over and over and over again. Kind of that Kaizen mentality of just get better and better every day. And so our team is, we're not chasing things, and we're also not trying to get everything right. That is, I think, the other thing that in markets in general, but particularly in the blockchain space, there's so much noise. And so just being able to say no and really focus on what are the 2 or 3 or 4 things we truly believe that underpin our thesis, and finding the N of one entrepreneurs building in those areas, or the N of one secular trends and themes that we can invest behind, and then put the entire weight of our firm into making those things as much of a reality as possible. I mean, that is like all we can really ask of ourselves. And that has been, our focus. I think if we get that right, we'll be fine.
All right, Ben, I want to make sure I ask you a couple of new closing questions. What was your first paid job and what did you learn from it?
So I grew up in Seattle, Washington. And when I was 14, I got paid by the Seattle Times to collect high school basketball game box scores. So I actually got paid $20 to call in and tell them how many points, rebounds, and assists each player and each team had, which was great money at the time for a 14-year-old. And actually, funny anecdote about this is I could only be in one place at a time, right? So I would go to my high school game anyway, but I ended up calling friends at other schools and getting them to provide me the box score. And I actually got leverage on my own time, which was a great lesson for me on, building businesses and getting leverage on my time instead of getting paid by the hour.
How's your life turned out differently from how you expected it to?
Well, I could have never guessed I would be in this industry in crypto. when I was at KKR, I thought I was going to be there forever. And I loved my job at KKR. I loved investing in, across the capital structure and credit and distressed. But I could have never imagined that, one, I'd be investing in crypto. Two, that I would be fortunate enough to be working at as part of such a great team, people that I respect. I just find it very humbling. And that's one of the things that I'm, really, really grateful for.
What's a mystery that you wonder about?
So I'll make this about crypto. So Bitcoin was created by this guy or gal or group of people called Satoshi Nakamoto. And the fact that this is a $2 trillion asset that started in an obscure corner of the internet, focused on cryptography, and no one knows who that is one of the world's biggest mysteries to me. And will we ever find out? I'm not sure. But I think Satoshi Nakamoto, whoever he, she, they are, is will ultimately be, has triggered this entire movement. It kind of shows you that, a butterfly flapping its wings can kind of compound and cascade into something so incredibly meaningful. To me, that's a big mystery.
Ben, last one. If the next 5 years are a chapter in your life, what's that chapter about?
So I recently bought this calendar that it's called a Memento Mori calendar, and it has 52 columns and then about 85 to 90 rows. And the idea is each one of these data points is a week in your life. And to me, and so every week I've now filled in the bubble, right? And to me, it's a great reminder of just how short life is and how we don't always have, and there's no guarantees you're going to get to the end of the calendar, by the way. But to me, it's been just grounding to think about just the passage of time and how fast it can move. And so I kind of think about my life, not in chapters, but almost in sentences, and try to kind of make things more atomic. And I read a great book recently by Salil Bloom, 5 Types of Wealth. And they talk about, many people go about their lives just optimizing for one or two of these types of wealth, but there are all these different, but there's, there are all these different elements to, I think, what makes life rich and fulfilling. And it's a multidimensional equation. And so for me, my next chapter, maybe on the surface won't look that different from my prior 5 years. It's really just, I want to build deeper relationships with the people that I love. I want to build a deeper understanding of who I am. I want to achieve great things as a business with our team. And I want to have a great family life. So it's all those things, a continuation of the journey that I'm on now.
Ben, thanks so much for sharing this incredible update on the space.
Yeah, thanks, Ted. Great to talk.